Eddie, it's good to see you this morning. We're looking at a bit of a mixed open for stocks after that GDP report. What does it tell us about the health of the economy?
So I think the economy continues to prove to be extremely resilient, and it's on solid footing. You know, growth absolutely is slowing, but we are not even close to a recession right now. And the bond market is sending some mixed signals as well, too, right? So we're getting cross currents economically. ADP was strong. GDP was weaker than expected. The bond market is showing an acceleration of growth and inflation being priced in. And it's going to put the Fed in a really tough spot where I don't think they're going to be able to justify cutting rates as we get to December and next year. I do think they'll cut rates next week, but the bottom line is we're not in a recession, and for them to cut rates in a non-recessionary environment, the bond market is signaling that could present some big problems next year, because if inflation accelerates too much because of growth, because of them being very loose with their monetary policy, it could cause them to be forced to have to raise rates next year. And that's the last thing anyone wants to see, especially the stock market. I
think that would be a surprise, at least for stock investors at this current moment, Eddie. Based on that GDP report that we saw earlier, just about a half hour ago, what does that signal to you about inflation, specifically that PCE indicator?
So look, I think inflation right now, when you see the consumer is continuing to be extremely resilient, the number obviously has decelerated, but the bottom line is prices aren't coming down. It just means the rate of change of inflation is slowing. And my concern is if we continue to have loose monetary policy with the Fed cutting more rates, that could cause these numbers to actually start to increase, meaning the rate of change of inflation, instead of going down, which is what we want to see, could start going up. And when you take a look at where we are with energy prices being volatile, when you're looking at certain commodities starting to show some acceleration as well, too, they're in a really tough spot because they're trying to stabilize the labor market, but they also have a price stability mandate. And I think they're going to have to force themselves to look at that price stability mandate a little bit closer in their monetary policy as we look forward over the next 12 months.
We get that jobs report on Friday as well, Eddie, and even though we've seen certainly the jobs data come in solid over these past several months, pointing to a decent labor market, some guests on my show have noted that we could see it skewed on Friday because of recent strikes, including at Boeing, as well as extreme weather, like some of those hurricanes that we saw down south. What are you expecting in that all-important jobs report Friday?
So I think the jobs report is going to be a tougher one to read because of those things that you just talked about. But I think the thing we need to understand is those are one-off events. So those jobs will come back on. But the bottom line is those folks that are on strike are still getting paid. So the way the government looks at it is they're still on the labor market numbers. So the labor market should continue to show resilience and show strength. Which again is another data-dependent point that the Fed is going to look at in regards to determining how aggressive they cut rates or if they continue to cut rates. So I think the job market is going to continue to prove that from a data perspective, a recession is not on the horizon here in the near term. And doesn't justify cutting rates.
October has been such a pivotal month, certainly these past several years. We saw the market bottom in October of 2022. We are 2 years now, a little more than 2 years, technically, into this bull market. If the Fed does slow its pace of rate cuts, as previously forecast, Eddie, but growth does hang on, what would be your projection for equity prices?
I think equities will do very good in that environment. You know, when you look at bonds, everyone's worried about the 10-year bond accelerating. You have to understand as to why it's accelerating. If you know the why, it can kind of give you a good idea from a market standpoint. I believe the why is because it's pricing in growth accelerating and inflation accelerating. And that's really good for risk assets. So I think their monetary policy, even if they said they're not going to cut rates, you'll get an initial reaction of downward, of course, in the market. That'll be a reaction function to that statement. But the reality is, if the fundamentals are strong, it should still be really good from a market standpoint. So we think the market will be extremely resilient and continue to be strong over the coming months.
Let's talk about Alphabet really getting things started for these mega cap technology companies reporting earnings this week. It reported better than expected results last night, really fueled by the cloud. Do you think that these large tech companies out there can continue to lead the market?
I do, and one could make an argument that they are considered more defensive plays anymore. You know, you've seen the NASDAQ and especially the mega cap tech names show a lot of resilience in the volatility that we've seen. Because the fact of the matter is, those are the most highly owned assets. Those are large companies. And I don't think you can have the market go higher without them leading the charge. So I expect this earnings this week overall to be strong. And continue to support the fact that mega cap tech is going to continue to be one of the areas that investors are going to want to be in. And until anything proves otherwise from a growth perspective, I think they're going to continue to lead the way.
What do you want to hear in the earnings reports and subsequent earnings calls from executives when it comes to these tech companies this week?
The biggest thing we want to look at is CapEx spending. We want to see what that's going to look like, as well as future guidance. You know, you can only say AI so much before that's going to start to wear out. I think what you're going to want to see is how they're able to monetize AI. We know a lot of these companies are investing a lot into artificial intelligence, but now we want to know how they're able to actually monetize that. So that's going to be a big thing. We're going to want to look at that tonight when we see Meta's earnings after the bell, and see if they're able to monetize that and to add revenue. But that's going to be the biggest thing, is future guidance, because that to me is going to hold more weight than what's happened in the past.
Well, the election less than a week away. Eddie, we'll see how the balance of power shakes out in our nation's capital. In this crucial week, what are you advising clients? Do they stay the course, or are you recommending that they update their portfolios?
So we've actually positioned our portfolios, because of the run we've had, to be a little bit more defensive by staying overweight mega cap tech, but we actually increased cash over the last couple of weeks. We just think it's prudent to play a little bit of defense going into such a big event like next week. My biggest concern from an election perspective is not actually knowing who the winner is on Wednesday morning, because I think that will create a lot of uncertainty from the market, and you could see some of these trades unwind from a short-term perspective. But we would look at that as a buying opportunity. So we're looking at the month of November to be actually volatile, with probably some more downside than upside over the first few weeks. And that's going to be the month where we want to get fully invested with the cash unless something changes fundamentally. So that's how we're playing it. So we're overweight mega cap, but we have a cash position higher than what we've had going into such a big event.
Eddie Ghabour, managing partner at Key Advisors Group. Eddie, I hope you'll join again after the election in November. We appreciate your time.
Thank you so much.